fair value gap is a liquidity gap that balances the inefficiency in the market. If you are a trader looking for a pullback strategy that guarantees 70 to 80% profitable trade, I would advise you to stay back and watch this video to the end, as we will be discussing one of the best pullback strategy called fair value gap. Stay tuned. I'll be right back. I am Oya Benjamin, and this is Xander FST. We provide you with videos and tutorials that help you maximize profit and minimize losses. Stay tuned as we dive into the video properly. Fair value gap, also known as the liquidity gap, balances the inefficiency in the market. Fair value strategy spots trend pullback and continuation. It shows you where a correctional wave is likely to end before the impulsive wave continues. For a proper understanding, if you are new to the trading world, I want you to understand that the market does not move in a straight pattern. No, okay? Now, the market moves in this pattern. The impulsive wave being intercepted by a correctional wave. Now, the impulsive wave continues again. Now, that is how it goes on and on. Now, the impulsive wave intercepted by the correctional wave now changes the character or changes the movement of the trend, then reconnects back again to the previous trend and continue its movement. Now, let's go to the video properly as we understand the right application of fair value gap. For us to be able to understand the video properly, we're going to be dissecting this video into subtopics. First of all, we are going to be looking at when and where should the fair value gap be used. Now, the second thing we are going to be looking at in this video is how to spot a valid fair value gap. Now, after that, we are going to be looking lastly at how to use fair value gap strategy in our trading. In a fair value pattern, 3 candlesticks must be involved. Okay, now we have candle 1, candle 2, and candle 3. Okay, now one of the candle must be the longest. The 2 other candles following are the ones that create the gap. In order to identify the gap, you connect the high of candle 1 and the low of candle 3. Okay, now that gap between candle 1 and candle 3 gives us the fair value gap. When and where should I use the fair value gap? Once there is a strong trend making series of higher high, higher low in bullish trend, or lower highs, lower low in bearish market, a fair value gap should be used. Let's look at the second subtopic, which is how to identify a valid and an invalid fair value gap. Number 1 criteria that will help you to identify a valid fair value gap is that the 3 candles that forms the fair value gap must be the same color. If it is a bullish fair value gap, the 3 candles should be bullish. And if it is a bearish fair value gap, the 3 candles must be bearish. Now, in a situation whereby you have 2 of the candles bullish and 1 of the candle bearish, or in a situation whereby you have only the middle candle bullish and the 2 remaining candle bearish, that fair value gap is not a valid fair value gap and should not be traded. Now, because a market will only respect a valid fair value gap. Let's look at another way fair value gap occurs, and let's look at how valid and how invalid it could appear. Now, if you look at these three candles, you will discover that these three candles, they are the same color. Criteria number 1 was met. Then why is this pattern an invalid fair value gap? The fair value gap must not be filled before the pullback occurs. Now, once a fair value gap is filled before the pullback occurs, that fair value gap becomes invalid. Now, look at it here. You can see that this is a fair value gap, but you observe that the fair value gap has already been filled by the next candle before the pullback itself. Now, with this candle filling the fair value gap before the pullback itself makes the fair value gap invalid. Once the fair value gap is not filled by the fourth candle, that fair value gap is valid. So these are the two patterns of fair value gap and how to know the one that is valid and the one that is not valid. Always remember that the market trend will respect a valid fair value gap. Now, let's go to the final subtopic, how to use a fair value gap strategy in our trading. Now, let's go to the chart and see that properly. Now, look at the chart that we have here. A fair value gap occurred here. We have candle 1, candle 2, and candle 3. We connect the high of candle 1. We connect the low of candle 3. Now you discover that there is a gap between them. Now that gap is called a fair value gap. Now let's look at our criteria and see if this fair value gap met the criteria. Number 1, because it is in an uptrend, the fair value gap must all be bullish. You can see 1, 2, 3, the 3 candles are bullish. So requirement number 1 met. Now number 2, there must be a gap between the fair value gaps. You can see that there is a gap between candle 1 and candle 3. Okay, requirement number 2 met. Now the fourth candle that is following must not fill the fair value before the pullback itself. Now look at it here. You discover that this is the fourth candle and it did not fill the fair value. Now with these 4 requirements met, now this makes our fair value gap valid. And once it's valid, the market must respect it. Now look at it here. The market moved up, the impulsive wave. Now the correctional wave took in, intercepted the market. Okay, now look at it here, respected the fair value gap. Now how do I know when the market respects a fair value gap? Number 1, the market, the trend will close within the fair value gap. Now once the market or the market trend closes within the fair value gap, okay, now the market has respected the fair value gap. Are we there? Now sometimes the market can close within the fair value gap, but the wick outside the fair value gap, that is okay. The market has respected it. In some cases, both the market will close inside the fair value gap and the wick will be inside the fair value gap. On that note, the market has also respected the fair value gap. But if the market closes below the fair value gap, the gap is not respected. And I want you to note, Whenever a fair value gap is not respected by the market, it gives you a signal of reversal in price movement. But whenever the market trend respects the fair value gap, it gives you a continuation pattern, telling you that the pattern, though disrupted, will still bounce back and continue in its previous pattern. Now let's go to the chart as we see live applications of this in our chart on how we can use the fair value gap. Okay, now let's look at the chart. You can see that on this place we can spot a fair value gap. We have candle 1 here, candle 2 here, and candle 3 here. Okay, let's look at the validity of the chart. Now, number 1, the colors must be the same thing. Okay, now look at it, they are in uptrend, they have the same color, and there must be a gap. Criteria number 1, there must be a gap between the candles, between candle 1 and candle 3. Criteria number 2, there must be the same pattern. Now it is a bullish candle and they are all in green. 2 criteria met. Now what are we going to do? We are going to plot from the high of candle 1, connect it through to the low of candle 3 and draw out. Let me zoom it out. You look at it here, you discover that a gap was between them. Now what happened? The market in an uptrend was intercepted by a minor correctional wave, okay, respected the fair value gap. You look at it there, you discover that it closed on the fair value gap with the wick inside the fair value gap, and the next thing is a pullback. I believe you have learned something from this video. But before you go, don't forget to hit the subscription button, like, and share the video as it helps the channel to grow. Have a successful trading week ahead. Bye.